There is a financial operating system running in the background of your life. It is invisible to 99% of the population. You were never taught it in school. You were never meant to use it. And most people have been actively steered away from ever seeing it. But once you see it, once you understand the mechanics of the machine, you cannot unsee it. You start to understand why you feel like you are running on a treadmill. You work harder every year. You get a raise. You save money, but you never seem to get ahead. The house you want gets more expensive. The grocery bill gets higher. The taxes take a bigger bite. You feel like the finish line is moving away from you. And you are right. It is moving. Because you are playing a game that is mathematically rigged against you. You are playing the game of income. But the wealthy, the top 0.1%, they are playing a completely different game. They are playing the game of assets. And in their game, the rules of gravity do not apply. In their game, taxes are optional. Debt is income. And inflation is a friend, not an enemy. This is not a conspiracy theory. This is the tax code. This is the banking system. This is the invisible engine of inequality. And right now, that engine is running at red line. Let's look at the scoreboard. According to the Federal Reserve, the top 1% of Americans now own $44 trillion in wealth. Read that again. $44 trillion. That is more wealth than the entire middle class combined. How did this happen? How did the gap become an abyss? The media will tell you it's because they work harder, or because they are innovators. That is a lie. Hard work does not generate $44 trillion. Innovation does not generate $44 trillion. Compound interest on tax-free money generates $44 trillion. The wealthy have discovered a glitch in the matrix, a strategy known as buy, borrow, die. It is the specific mechanism they use to opt out of the system that crushes you. While you are worried about the 2026 crash, they are using this mechanism to float above the wreckage. While you are worried about inflation destroying your savings, they are using inflation to erase their debts. Today, I am going to show you the blueprint. I am going to show you exactly how the machine works. And I am going to show you why it creates a mathematical trap that you cannot work your way out of. Welcome to the real economy. Welcome to capital cycles. To understand the trap, we have to understand the difference between you and them. The difference comes down to one single word: selling. The average person thinks that to make money, you have to sell something. You sell your time for a paycheck. You sell a house to cash out the equity. You sell a stock to lock in a profit. But here is the secret. Selling is a trap. Selling is a taxable event. When you sell your time, you pay income tax, the highest tax rate in the code. When you sell an asset, you pay capital gains tax. Every time you sell, you hit the reset button on your wealth. The government takes 20%, 30%, or 40% of your progress, and you have to start over with a smaller pile of money. This friction destroys compounding. It is like trying to drive a car with the parking brake on. The wealthy know this, so they follow a simple rule: never sell anything. This sounds impossible. If you don't sell, how do you eat? How do you buy a yacht? How do you pay the bills? This is where the magic trick happens. This is where the invisible engine kicks in. Instead of selling the asset, they borrow against it. They walk into a bank. They put their assets on the table as collateral: stocks, real estate, art, and they ask for a loan. Why? Because of a specific line in the U.S. tax code: borrowed money is not income. Let that sink in. If you earn $1 million working as a doctor, the IRS sees income. They take $400,000. You keep $600,000. But if you borrow $1 million against your stock portfolio, the IRS sees debt. They take zero. You keep $1 million. It is completely tax-free cash flow. You can spend it. You can invest it. You can live on it. And you pay zero taxes. In fact, it is better than zero, because the interest you pay on that loan, in many cases, it is tax deductible. So not only do you not pay taxes, you get a tax break for borrowing money. This is the infinite glitch, and the scale of it is terrifying. Right now, U.S. billionaires are holding an estimated $8.5 trillion in unrealized capital gains. Unrealized means they haven't sold. Unrealized means they haven't been taxed. That is $8.5 trillion of wealth that exists in the economy. That creates power. That creates leverage. But it contributes almost nothing to the tax base. This is why Warren Buffett pays a lower effective tax rate than his secretary. It isn't because he cheats. It is because he plays a different game. He plays the game of asset accumulation. She plays the game of income generation. And the tax code is designed to punish income and reward assets. But you might be thinking, wait a minute, if they borrow money, they have to pay it back. They have to pay interest. Won't the debt eventually crush them? In a normal world, yes, but we do not live in a normal world. We live in a world of fiat currency. And this brings us to the historical context, to the origin of the cheat code. We have to go back to 1913, the creation of the Federal Reserve, and more importantly, the year 1971, when the U.S. dollar was taken off the gold standard. Before 1971, money was an asset. It was tied to gold. It held its value. After 1971, money became a liability. It became a currency that could be printed to infinity. This changed the physics of wealth. In a fiat system, the government creates inflation intentionally. They target 2% inflation per year. But real inflation is often much higher. What does inflation do? It destroys the value of cash, but it boosts the value of assets. If you own a house or a stock, inflation makes the price go up. But here is the kicker. Here is the part that makes buy, borrow, die mathematically invincible. Inflation also destroys the value of debt. If you borrow $10 million today, and inflation is 5% a year, in 10 years, that $10 million is worth significantly less in real terms. But the asset you bought? The asset has grown with inflation. So the rich get a double benefit. Their assets go up, and their debt goes down, mathematically, automatically, without lifting a finger. This is called debasing your liabilities. It is how the government survives its $38.3 trillion debt pile. And it is how the billionaires survive theirs. They are shorting the dollar. They are betting that the currency will lose value. And they are winning that bet every single day. Meanwhile, the worker, the saver, the person following the Dave Ramsey advice to get out of debt, they are holding the bag. They are holding the currency that is melting like an ice cube. They are saving money that is losing 5% of its value every year. They are swimming upstream against a current of monetary debasement. They can never catch up, because the math forbids it. You cannot outwork a currency printer. You cannot outsave an inflation rate that exceeds your raise. This is the tragedy of the American dream. We told people to work hard and save, but we built a system where savers are losers and debtors are winners. This is the mechanism. Buy assets. Watch them grow tax-free. Borrow against them tax-free. Use inflation to erode the debt. Repeat. It is a perpetual motion machine of wealth extraction. But there is a final step. They, part of buy, borrow, die. This is the ultimate loophole. The final insult to the working class. You would think that when the billionaire dies, the IRS finally gets paid. The loans come due. The taxes are levied. But you would be wrong. There is one more twist in the tax code. A twist worth $50 billion a year to the Treasury. It is called the step-up in basis, and it wipes the slate clean when you die and pass your assets to your children. The cost basis of those assets is reset to the current market value. If you bought a stock for $1 and it grew to $1,000, you have $999 of taxable gain. But if you die, your heir receives the stock at $1,000. The $999 of gain? It vanishes. It is never taxed. The tax liability is deleted from the server. The heirs can sell the stock the next day for $1,000 and pay zero capital gains tax. They can use the proceeds to pay off the loans their parents took out and keep the difference. The cycle completes. The wealth transfers, the taxes are avoided, and the dynasty continues. This is why the top 1% owns $44 trillion. It is not magic. It is mechanics. It is a system designed to concentrate wealth at the top and strip mine wealth from the bottom. But here is the danger. Here is why we are talking about this now. This system works perfectly until it doesn't. It relies on one critical assumption. It relies on asset prices always going up. It relies on the everything bubble getting bigger forever. But what happens when the bubble stops growing? What happens when the collateral, the stocks, the real estate drops in value? What happens when the bank makes a margin call on a billionaire? We are approaching a point of maximum instability. The invisible engine is overheating. The debt levels are too high. The valuations are too extreme. And the 2026 reset is looming when the crash comes. The buy, borrow, die strategy faces a stress test it hasn't seen since 1929, and for those who are over-leveraged, it will turn into buy, borrow, bust. But for the smartest players, for the ones who understand the cycle, they are already preparing. They are shifting their strategy. And if you want to survive what is coming, you need to understand what they are doing next. You need to understand the defensive pivot, because the game is about to change. You might think this system is invincible. You might think the wealthy have a permanent cheat code. But there is a catch, a massive, terrifying catch. And it is the reason why billionaires like Jeff Bezos and Mark Zuckerberg are suddenly selling stock for the first time in years. They are breaking the never sell rule. Why? Because the buy, borrow, die strategy has a fatal flaw. It relies on two specific variables to function. Variable number 1, asset prices must keep going up. Variable number 2, interest rates must stay low. For the last 40 years, from 1982 to 2022, we lived in a Goldilocks era. Interest rates went down. Asset prices went up. It was the perfect environment for the invisible engine. You could borrow at 2% or 3%, and your assets grew at 10% or 15%. The spread was massive. The math was easy. But in 2025, the math has broken. The Goldilocks era is dead. We have entered the era of the bear trap. Let's look at the data. The verified numbers that prove the engine is overheating. First, the cost of borrowing. The Federal Reserve raised rates at the fastest pace in history. The prime rate, the rate banks charge their best customers, jumped from 3% to 8.5%. Think about what that does to the borrow strategy. If a billionaire borrowed $100 million against his stock in 2021, he was paying maybe $2 million a year in interest. Manageable. Today, that same loan costs $7 million or $8 million a year. The cost of carry has quadrupled. Suddenly, the debt isn't a tool. It is a burden. It is a bleeding wound. And this leads to the second, more dangerous problem, the collateral. Remember how the loan works? The bank gives you money because you pledge your assets, your stocks, your real estate. But the bank isn't stupid. They have a kill switch. It is called the LTV ratio, loan to value. If you have $100 million in stock, the bank might lend you $50 million. That is a 50% LTV. But what happens if the stock market crashes? What happens if that $100 million portfolio drops to $60 million? Suddenly, your $50 million loan looks very risky to the bank, so they make a phone call. The call that every investor has nightmares about. The margin call. They tell you to deposit more cash immediately, or they will sell your assets. At the bottom, to pay off the loan. This is exactly what happened in 1929. It wasn't just small investors who got wiped out. It was the smart money that was over-leveraged. They had borrowed against their fortunes to buy more when the market fell 10%. The banks called the loans. To pay the loans, they had to sell stocks. The selling drove prices down another 10%, which triggered more margin calls. It was a death spiral, a liquidity cascade. And right now, in late 2025, we are seeing the setup for the exact same event, only this time. The leverage isn't just in the stock market. It is everywhere. It is in commercial real estate, where developers borrowed cheap money to build empty towers. It is in private equity, where firms borrowed cheap money to buy businesses. And it is in the accounts of the ultra-wealthy. This brings us to the defensive pivot, the reason you're seeing headlines about insiders selling. Why did Jeff Bezos sell $8.5 billion of Amazon stock in a single month? Why did the Walton family sell $4.5 billion of Walmart? Why is Jamie Dimon selling JP Morgan stock for the first time in history? The media tells you it is for tax planning or estate planning. Do not believe them. They are deleveraging. They are paying off their loans. They are taking chips off the table because they see the storm clouds gathering. They know that the buy, borrow, die strategy works great in a boom. But in a bust, it creates a forced seller. And there is no worse position in finance than being a forced seller. This is the pattern recognition we talk about. The elites are moving from offense to defense. They are moving from debt to cash, because cash is the only asset that doesn't have a margin call. But where does that leave you? Where does that leave the person who is trying to catch up? You might be thinking, if the system is about to break, maybe I have a chance. Maybe the crash will level the playing field. I hate to tell you this, but a crash does not help the poor. It hurts them the most when the credit cycle turns. The banks don't just call the loans of the billionaires. They cut off the credit of the working class. Credit card limits get slashed. Car loans get denied. Mortgage become impossible to get. The ladder of opportunity gets pulled up. And the assets that go on sale, the houses that drop 20%, the stocks that drop 40%, you won't be able to buy them because you won't have the credit and you won't have the cash. Who will buy them? The people who sold at the top, the people who are raising cash right now, the people who understand the cycle. They will use the crash to buy your assets for pennies on the dollar. This is a wealth transfer. It is the final stage of the trap. The system is designed to use debt to enslave you in the boom and use deflation to strip you in the bust. It is a two-phase attack on your sovereignty. Phase 1, inflation. Make things expensive so you have to borrow to survive. Phase 2, deflation. Crash the asset value so they can repossess what you bought. This is the history of the world. From Rome to the Weimar Republic to 2008, the mechanism changes slightly, but the result is always the same: concentration of wealth, elimination of the middle class. So, is there a way out? Is there a way to use their own weapons against them? Can you use the buy, borrow, die mechanics without the billions, without the team of lawyers, without the risk of ruin? The answer is yes, but you have to change your mindset. You have to stop thinking like a consumer who borrows to spend, and start thinking like a capitalist who borrows to produce. You have to build your own invisible engine. It won't be as big as theirs, but it can save you. It can be the life raft that gets you through the 2026 reset. In Part 3, I am going to give you the micro playbook. I am going to show you the specific assets regular people can buy that allow you to access the tax advantages of the wealthy. I am going to show you how to leverage good debt while eliminating bad debt. And I am going to show you the one asset class that stands outside the system entirely. The asset that has no counterparty, no margin call, and no tax liability until you choose to sell. The trap is closing, but the exit is still open. You just need the key. The system is rigged. That is a fact. But complaining about it will not save you. Protesting in the streets will not lower your taxes. Voting for a different politician will not stop the Federal Reserve from printing money. The only way to win a rigged game is to stop playing by the loser's rules. You have to stop playing worker and start playing owner. You don't need $1 billion to do this. You just need to change the assets you hold. You need to move from liabilities to store of value. Here is a micro playbook. It is the scaled-down version of the billionaire strategy. It consists of 3 specific steps you can take right now to build your own invisible engine. Step 1, the asset swap. Stop saving in cash. Cash is a melting ice cube. It loses 3% to 5% of its value every year due to inflation. If you keep your emergency fund in a checking account, you are voluntarily paying a 5% tax on your own safety. Move that liquidity into cash equivalents that pay you. Short-term U.S. Treasury bills, high-yield savings accounts, money market funds. Right now, these pay 4% or 5%. It isn't a fortune, but it stops the bleeding. It allows you to tread water while you wait for the opportunity. Step 2, the good debt pivot. We are told that all debt is bad. That is false. Consumer debt is bad. Credit card debt at 22% interest is slavery. Car loans for a depreciating asset are wealth destruction, but asset debt is a tool. The wealthy use debt to buy assets that pay the debt off. For the average person, this usually means real estate, but not just any real estate, cash-flowing real estate. If you buy a rental property, and the rent covers the mortgage and the repairs, and puts $200 in your pocket every month, you have just created a mini buy, borrow, die machine. The tenant pays the interest. The tenant pays the principal. The tax code gives you depreciation to offset the income. And in 30 years, you own the asset free and clear. And you never paid a dime of your own money to buy it. This is leverage. This is how you use the bank's money to build your freedom. But be careful. Debt is a double-edged sword. In 2026, when the crash comes, you must not be over-leveraged. You must have cash reserves. The goal is to use debt as a bridge, not a crutch. Step 3, the sovereign reserve. This is the most important step. This is the die insurance, or rather, the system failure insurance. The billionaires hold stocks in real estate. But those assets are inside the system. They can be frozen. They can be taxed. They can be seized. You need an asset that exists outside the system. You need gold, physical gold, not an ETF, not a mining stock. The actual metal. Why? Because gold is the only asset that is not someone else's liability. It is the enemy of the buy, borrow, die system. B, because it cannot be printed. It cannot be debased. When the government prints $10 trillion to bail out the banks in 2026, the value of the dollar will collapse. But the price of gold will skyrocket. It is the ultimate hedge. It creates a floor for your wealth that cannot be broken. And for the digital age, Bitcoin serves a similar function. It is digital gold. It is a decentralized ledger that no government controls. But it is volatile. It is for the risk-tolerant. Gold is for the risk-averse. You should probably own both. Step 4. The step-up strategy for the middle class. You don't have to be a billionaire to use the death loophole. If you own a home, and it has appreciated in value, and you sell it before you die, you pay capital gains tax. But if you hold it until you die, your children inherit it at the current market value. They can sell it tax-free. This creates a generational transfer of wealth for your family. Instead of leaving them a tax bill, you leave them an asset base. This requires planning. It requires a trust. It requires talking to a lawyer. But it is worth it, because it stops the government from taking 40% of your life's work at the finish line. This is the path. It is not easy. It is slow. It requires discipline. It requires sacrifice. You have to live below your means today, so you can buy assets for tomorrow. You have to say no to the new car, so you can say yes to the rental property. You have to stop trying to look rich, and start trying to be rich. The difference is massive. Looking rich is a liability. Being rich is an asset. The 2026 reset is coming. The everything bubble will burst. The invisible engine will sputter for the people who are unprepared. It will be a disaster. They will lose their jobs. They will lose their homes. They will lose their hope. But for you, for the person who understands the machine, it will be the opportunity of a lifetime. When the prices crash, you will have the cash to buy. When the panic sets in, you will have the gold to survive. When the dust settles, you will be the one holding the assets. You will be the one on the right side of the wealth gap. The system is unfair. The game is rigged. But you have the rule book now. You know the cheat codes. You know how the engine works. The only question left is, will you use it? Will you take action? Or will you let the machine grind you down? History does not care about your feelings. It does not care about what is fair. It cares about who is prepared and who is not. The transfer of wealth has already begun. The clock is ticking. Tick, tick, tick.